everybody, and welcome back to today's episode. We're going to talk about how to get started investing in a real estate syndication deal. And I want to break this down and make it very simple that anybody can follow just to get started. For those of you who don't know what a real estate syndication is, it is basically when you're able to pool your money as investors together to buy larger assets. You might not be able to buy an apartment complex, but if all you and your friends and family all threw in, 10, 20, 30, $50,000 each, you could buy a multi-million-dollar apartment complex. That's kind of what this is. And usually there's a sponsor and an operator involved. The sponsor is usually the one facing that people see. You've probably seen some ads out there about investment opportunities for accredited investors. You've probably had maybe some people even reach out to you, friends and family, saying that they got a real estate investment that they're, pooling or syndicating for. This is basically what that is. And so here I want to go through the 6 steps that you can take to do it. Number 1 is do your research. Start by learning about the different types of real estate syndications and the potential risks and rewards of each. It's very important that you understand the legal and financial aspects of these investments before diving in. Big part here is understanding the difference between debt and equity. Usually as a real estate syndication, you're an equity investor, meaning you're a partner in the deal. Your money is going into a bank account, and then a bank is going to lend money on that money. It is seen as equity in an investment and used as usually a down payment to get a bank loan to buy the property and renovate a property. If you're in the multifamily world, if you're in the development world, it's usually as a down payment to get a loan to build something. So make sure you understand exactly what you're lending on. There are debt funds as well. Understand the nuances and risks involved. If you're an investor and you're investing as equity, you want to know what your break-even point is. And at one point you start to lose money. What are the risks? Because with equity, if the value of the asset falls below a certain point, you could potentially lose all your investment. There's more risk. This is usually why equity generates higher returns, is there's a little bit more risk involved because there's more profit. The money is being used as leverage. Your money is being used to go get even more money from a bank. Whereas if you're debt, usually if you're having to foreclose on that property, you are getting the property or a share of ownership back to the property. Therefore, there's a little bit less risk involved. You want to know what your break-even point is or your loss of capital point if you were to re-require an asset. That's very important to know. So start by doing your research and understanding what the potential risks and the rewards are for doing your research and investing in that asset. The second, and I can't stress how important this is find a reputable sponsor. A sponsor is the person or company responsible for finding and managing the investment. Look for a sponsor with a track record of success and a reputation for honesty and transparency. So doesn't matter how good a deal is, a bad sponsor can basically ruin it. I know people who have lost all their money to a real estate investor because they invested with the wrong person. It was a great deal. Finances wasn't managed right. The deal wasn't managed right. Good deal turns into a poorly managed deal, which turns into a bad deal, which can basically lead to a capital loss, and it can really sting. So make sure I'm a big fan of looking at the track record, setting up multiple calls with the sponsor to vet them. I even go as far as doing a background search on some of them as well, and really just trusting my gut, right? I usually get a feel for someone if I like them, if I trust them after 3 or 4 interactions with them. And so I look for this. So the deal's got to be good, and it has to be a reputable sponsor. Number 3 is understand the terms of the investment. So before committing to an investment, make sure you fully understand the terms of the deal, including the expected return on the investment, the length of time on the investment, and any fees or expenses you'll be responsible for. I have personally gotten phone calls from people who have been like, dude, is everything going okay? It's been like 14 months. I thought you said that, we were going to get in and out of this deal in like 12 months or less. We do a lot of entry level new construction housing. And I'm like, yes, but anything can happen. As I explained, it's no guarantee I can get it in 12 months. Things happen. Interest rates go up. Market does some funky stuff. Costs of construction go up. Supply chain issues from a virus no one saw coming prevent businesses from being able to get the materials to build the house on time. So there's a lot of things that can come up that can affect the performance of your investment and the time that it takes to get your investment out, right? There's really three important things to consider. That's capital preservation, making sure you don't lose money. Then there's return on capital, like, hey, did you make 10%, 15%, 20%? And your return of capital. That's a big one, because your capital might be safe in an apartment complex, but if interest rates go up and they just keep having to refinance into new loans and you never get your capital back, well, that's a big problem. So return of capital is very important. So understand how you're going to get your money back when you're looking to the deal. The fourth thing that you need to do to get started is perform due diligence. It's important to thoroughly research the property and the sponsor before making the investment. This may include reviewing financial statements, visiting the property, and speaking with industry experts. I always love, hey, do you have some other investors who've been investing with you for a long time that I can talk to? All right. I love that question. I want to talk to people who they may not be used to introducing or recommending, right? I kind of want to catch them off guard and see how they react. Are they hesitant to introduce me to the people that I'm asking to be introduced to? Or are they kind of like, like, we can't do that, and immediately put up a block? Like, usually the people who want to get a deal done or reputable will let you talk to other people who they have spoken with. And again, I did another episode that talks about the 8 roles involved. You can try to talk to the accountants. If you can get involved, talk to the attorney that's doing the deal. Talk to other investors doing the deal. They probably won't let you talk to the lender. Lender's not going to talk to you, but try to speak with as many parties involved in the deal as possible. I'll tell you another thing that people don't do enough due diligence on is, like, in development or apartment remodels, who are they doing for contractor work? Because the contractor is going to make or break that deal, I promise you. And so the reputation of that contractor and their performance is really important. A lot of people don't do that due diligence. Number 5 is get professional advice. Consider seeking the advice of a financial advisor or attorney to help you evaluate the investment and ensure that it aligns with your financial goals and risk tolerance. I had a sweet elderly lady sit down with me. She did one of our calls, or investor introductory calls, and she was getting to know us. We were getting to know her. We're having a lot of fun. She was very interested. And I'd sent her some past deals that we had done to familiarize herself. And she said, hey, can I book a call with me and my accountant? And I said, sure. And so we did a Zoom call like 2 weeks later with her and her accountant right there. And the accountant was drilling me with questions of my background and experience. And, we had a really good call. So I didn't mind doing that. I was more than happy to do that. So getting professional advice and third-party advice is not a big deal. Just make sure you get it from the right person. If you break your leg, who do you go to? You go to a doctor. You don't go to your dentist. So don't ask your friends and other poor people for professional financial advice. Don't do it. Get it from a professional. And 6, last step in getting started in real estate syndication deal, and really nothing beats experience, you have to invest. Once you've thoroughly researched the investment and you feel comfortable with the terms, you can invest by contributing your capital to the syndication. Be prepared to be an active participant in the management of the property if it warrants it, as you'll be a co-owner along with the other investors. So you're going to own this thing. If you're a limited partner, you're going to be a part owner in that asset, whatever that may be. So your money's in it. You're owner. Start doing what you need to do to fulfill your obligation. Usually, if you're a limited partner, that means that you just have to sit back and relax. The sponsors should do all the heavy lifting. The general partners should take care of everything. But if you're investing as a general partner, your capital, then be prepared to do some owner stuff. You might have to get involved and get your hands dirty a little bit. All right. I hope this helps you get started investing in a real estate syndication deal. If you have any questions around this topic, please feel free to reach out to us. Till next time.